Welcome to Low Load Insurance Services' 8th webinar of 2010. Today's presentation will last about 50 minutes. The presenter today is Judy Freeman. Judy has worked in the insurance industry since 1985. Her first role was with the home office of John Alden Life Insurance Company as Vice President of Life Administration, which included policy service, claims, and policy issue. She has a strong background in compliance from her work at John Alden as the Life Division's point person for the Department of Insurance Market Conduct Reviews. She has played an active role in industry associations as well. She's been workshop moderator for Life Office Management Association meetings and annual workshop committee member of the International Claims Association. Since 2002, Judy has been a member of the LLIS team, first as Policy Owner Service Manager, and now in her current role as Licensing, Continuing Education, and Compliance Officer, where she is charged with ensuring the company and its associates are in compliance with the numerous state insurance regulations. Her expertise in and special perspective with policy service and claims has made her a valuable resource to advisors and their clients. Judy, take it away.
Thank you, Dina. One of the hardest things about talking to a client about life insurance is the fact that we're making them face their inevitable mortality. None of us are superheroes, but so many of us obviously think that we're going to live forever. How else can we explain the fact that so many important decisions are left to be dealt with tomorrow? The other dilemma that we have is that life insurance companies don't have clairvoyants on staff assisting the claims specialists to make sure that our clients' wishes are carried out. You've done your job as financial advisors, assisting your clients with their financial goals and recommending life insurance where you think that it might be needed. As your go-to people here at Low Load, our staff does everything that we can to make sure that your clients' wishes will be carried out. Before I get into the nitty-gritty of my presentation, I have to give you my disclaimer. I'm not an attorney, nor am I a tax advisor, consultant, or CPA. I'm not licensed to give tax advice. Any specific tax questions that you have should be referred to a licensed professional. So now let's get started. First thing that we're going to cover in our session today is beneficiary basics, some basic information on beneficiary designations. Then we're going to cover some not so basic situations along with some actual real life situations. We're going to talk about trusts as owner and beneficiary on policies. And then finally we're going to talk a little bit about how companies pay death benefits. Starting off with beneficiary basics, where a policy application first gets reviewed is in the underwriting area. And the underwriter is only interested, as far as beneficiary designations go, in whether there is an insurable interest between the insured and whoever they have named as their beneficiaries. There has to be some sort of loss that's going to be happening if our insured is out of the picture. And so as a result, unfortunately, I can't name myself as the beneficiary of the life insurance policy on someone that I don't know who ends up being the winner of a Powerball drawing. Unfortunately, I just can't have myself name that because I have nothing to lose if that person dies. Same token with different types of insurance, property and casualty insurance. I can't take out a car insurance policy if I don't own a car. There's no loss if I don't have a car, so why in the world would I have a car insurance policy? So the underwriters have to make sure that there is that insurable interest. One key point here, though, is that once the policy's been issued, if there is a change made, that insurable interest does not have to be satisfied. Now, again, talking about insurable interest, and then usually the beneficiary is going to be the spouse. We see the vast majority of life insurance policy applications that we take here where the first level beneficiary is the spouse. And that first level beneficiary, the actual terminology is that that's the primary beneficiary, and then next levels would be contingent. And you can have any number of contingent beneficiaries. You could have a second level contingent, a third level contingent. Anything can be tailored to meet the needs of our client. More than one person or entity can be named as primary or contingent beneficiaries. And this isn't limited to just the space that's either on the application or the change form. If we have a situation where there's a number of people listed as primary or contingent beneficiary class, we can just write in the space, "See attached," and attach a listing. Usually what we try to also do is have that listing, that attachment, also signed by the policy owner, signed and dated, so that we make sure that that is part of that either application or change form. Now, one of the things that is required is that if we do have multiple people listed in a beneficiary class, that their shares be listed in percentages. You'll see this on change forms where they have a notation that it must be listed in percentages. But sometimes there are problems that come up with trying to do a split that's strictly percentages. There's reasons behind the companies needing the percentages, and most of that is related to the fact that the death benefit can truly be a moving target. That death benefit amount can change, and some of the things that can change the death benefit could be a collateral assignment on the policy. That collateral assignment holder, either a bank or a lending institution, is going to have their hand out first for that death benefit. They will be first in line to receive whatever share or portion of that death benefit is supposed to be dispersed to them. Next up, another reason for a benefit to change would be an outstanding policy loan at time of death. The death benefit is going to be reduced by however much that loan is on the day of death. Decrease or increase to face amount, obviously that's going to be a situation where we're changing the death benefit, and that will create a problem if we've got dollar amounts. Partial withdrawals reduce the final death benefit. Misstatement of age. Life insurance policies have provisions for dealing with these sorts of errors. Hopefully it's a clerical error where an agent may have recorded the date of birth incorrectly or recorded the information incorrectly, so that the company actually set the person up with either a year up or a year down. The way that companies deal with this is that what they will do is they will, based on the actual age when the policy was issued, they will recalculate that death benefit using the age that the person should have been, and using the premium that was paid on the policy to recalculate a new death benefit. Next up, tax law, DEFRA, there's a corridor which must be met, and it's a relationship between the cash value on the policy and the death benefit. And if we have some of our clients that live to be a ripe old age, we have some policies that go well beyond age 100. If it's a universal life policy, almost guaranteed that that death benefit is going to increase above what they originally applied for, because the cash value has to be kept in relationship to the face amount. If the policy was a universal life policy and issued with option B, that means that the death benefit is going to be equal to the face amount plus the cash value. And because our policy cash value is a moving target, every day that interest gets recalculated, that death benefit is going to change at time of death. Now, there are ways around the percentage requirement. There are ways to resolve that problem. The best way to show it is through an example. We have a life insurance policy where we have a $100,000 original face amount. We have an outstanding policy loan of $25,000. So that's going to reduce our final death benefit down to $75,000. In our situation, we need to actually pay out $25,000 to beneficiary number one. Now, this might have been a divorce situation where